What's up, guys? We're here Sunday morning, putting in a little bit overtime. I was on the show. Actually, I don't know if you saw the end of the show yesterday, Kevin. So I was on with Kashop, and I was like, I have a feeling we're gonna do a show with Kevin this weekend. And I was like, I don't know why. I'm like, there's just a lot going on, and there's someone I'd like to talk to about this. So I hit up Kevin. Kevin decided we can come on today on Sunday, so we're really glad to have Kevin. So, kind of going through the market here, so much going on. It's been a kind of a wild beginning of the year. Some of these ETF sectors are just moving like crazy, whether it's uranium, energy's been making a nice move, and so on. So we're kind of in this zone where like the materials, the cyclicals, value is doing well. Small caps are doing very well. Materials are, I think, the leading sector this year, right with energy. So, Kevin, speaking about that in the broad market, if we're looking at the S&P 500, which is mainly technology and mainly the Mag 7, what are you seeing here in the S&P 500? Do you think it's a situation where this thing has a lot more upside, or are you thinking that there's this thing's getting a little bit long in the tooth at the moment?
Yeah, that's actually a really good question, and I want to first, obviously, thanks, man, for having me on. I always love coming on to the show here, and I'll come on anytime that I possibly can. So, uh, with the S&P 500, what are we seeing right now? I think it's really important for us to kind of give the backdrop of what actually occurred at the latter half of last year, and then kind of what we have seen for the first 2 weeks, 3 weeks of January. The last 2 weeks of December, obviously, we saw a very low volume, very low liquidity. Volatility levels were also very low as well. We were hitting kind of the lower end of that VIX range, and that VIX was kind of reflecting the second, third, and fourth week of what was actually going to happen here in January. And it's a lot easier to re-rate volatility higher, right? Left tail risk, if you will, could be re-rated a little bit higher than it is for a 14 VIX or even a 13.8 VIX to have that crush a little bit lower. So I think the fact that we had very low volatility kind of gave us the opportunity to see a little bit of a pullback or re-rating. We obviously had some macroeconomic and geopolitical news that has created a little bit of volatility in the market as well. We had tariffs kind of coming back into the picture. Tonight's open will also be very interesting. The threat of 100% tariffs on Canada might cause a little bit of angst within the market. And we did see a little bit of a pullback, that rotation trade, getting out of that technology sector and kind of spreading that out to other smaller sectors. Materials doing a phenomenal job. That's where the miners reside. Not only if you're looking at gold and silver, those are usually the headliners, but like the lithium miners, the Albemarles of the world, caught a significant bid over the last 3 months or so. Really nice bid. If you're looking at Southern Copper hitting up to $180, a nice little consolidation breakout higher. So materials have been able to outperform the industrial space as well, which has been kind of interesting. We started seeing a little bit of a sector rotation or industry rotation within the industrial sector, where you started seeing maybe Caterpillar kind of lose a little bit of steam, but Deere and Co. kind of catching a little bit of a bid to the upside, right? Staples as well. We saw Staples coming down, hitting a critical area of support. Costco was severely oversold. Now people are starting to buy into those names. So I think the market right now, or even over the last 3 weeks, let me say, has been looking for stocks that have been kind of basing out, that might be trading at very discounted levels compared to maybe some of the broader enthusiasm within the S&P 500. And then we have seen that kind of break to the upside. And then you have some technology stocks, Microsoft for that matter, that are well off 10%, 15, 20% of their all-time highs, kind of moving to the downside. Now, here's the thing that I think is actually very interesting and something to keep on the radar for next week. It's not a given, it's not a recommendation. But if you look at that, uh, the trading activity on Friday, it kind of went back into that Mag 7 concentration, and you sold out of a lot of those other industries and sectors that we kind of talked about that was gaining steam over the last 2 months, 3 months. We do have Mag 7 earnings this week. We have, I believe, four of the seven actually reporting this week, Microsoft being one of them. And I think you might actually have the situation where institutional traders now have gotten into that rotation trade. Now they're looking at these stocks that have been severely oversold. Going into an earnings announcement, those valuations are a lot cheaper than what they were 2 weeks ago, 3 weeks ago. And I think you probably are seeing maybe some more upside potential for the Mag 7 and a little bit more of this rotation. Now, that being said, technically speaking, we have this wedge. We try to break out of the wedge. It was a look above and fail. We are below the wedge right now. Came back, tested the 50-day moving average. We closed above that for the week. We closed technically above the 20-day moving average by like 2 points or so. So we were able to see a little bit of recovery. But if you look at that chart, the higher low scenario has now been broken. And so we did actually kind of break that sequence. This could be the start of a topping pattern. And we do have the seasonality and the weakness in seasonality pretty much at the start of February, first 2 weeks, 3 weeks of February, and then the last week of January. We also have the Fed meeting as well. We're not expecting any fireworks there when it comes to the rate cut, but the commentary obviously could be very meaningful here. So we are in a consolidation for now. Generally, if you're looking at the market over the long term, the markets generally melt up when you're looking at equities. But I would not be surprised if we kind of get this rotation type of trade back into Mag 7s over the next couple of weeks here. That might be enough for us to break us higher here. And if we don't, and we get bad earnings, I think that's when we see a breakdown. I think this chart's a little bit more bearish than bullish, though. So I want to be mindful. The technicals say a little bit more bearish than bullish. But when you look at the internals, you can make the case, okay, some of the heavier weighted companies within the S&P 500 have been oversold pretty aggressively here. A retracement bounce or even a dead count bounce for a week or 2 weeks is not outside of the question. That could be enough to try to get us to that 7,000 level for the S&P.
Yeah, I think it's, it's very interesting too. And I found this chart that you also brought interesting, which is looking at the Mag 7 names. And we're seeing some weakness in them recently. We're kind of in this lower high pattern that almost looks like it could be a topping pattern as well. Coming back to these moving averages, we could get rejected there. We're under the 0 line on your MACD, which is saying momentum is bearish. And, we could get one of those. And this is something that I'm sure you know about, Kevin, and most technicians know about, which is a MACD kiss, meaning we kind of hit this level here where you see this line circled. And with that blue line, sorry, I can't for some reason. It is showing up on the chart. Okay, there we go. So that blue line is going to basically hit that orange line, bounce off of it quickly, and that's what we call MACD kiss. And basically, we start heading back to the downside, which coincides with these moving averages. It's pretty close to actually this trend line. So there's a lot of things kind of going into this one. So what do you see in the Mag 7 names, Kevin?
Yeah, so this one is a little bit difficult. So let's go back, look at the technicals. What are we seeing on the longer term time frame, right? It's a bullish chart that has right now a bull flag, a flag or a consolidation that is taking place here. Now you get a little bit concerned, right, that you have this flag pattern taking place. The 20-day and the 50-day moving average pretty much are sitting at the right, the same areas at this point. Could it acted as an area of resistance? I mean, it's pretty much where we closed on Friday, but we were able to hold the $62.50 level if we're looking at the MAGS ETF as our proxy. So you could say right now, overall, this is a flag pattern that could also result in a breakout to the upside, but you got to overcome some of those moving averages. Now, MACD is trying to curl, so it is below that 0 line. It isn't obviously right now it's bearish momentum at this point. That MACD could cross in a bullish formation with that 12 EMA above the 26 EMA. That's where we could kind of complement that breakout to the upside, or at least trying to test that $67.70 level, which is going to be the top resistance level of that flag pattern, if you will. RSI is making lower lows. So we have not seen a higher low yet. That's the first signal you want to see as far as trying to trade a momentum or a reversal type of pattern here. And we still have this resistance zone. So right now, consolidation range, we were able to hold the $62.50 level. Once again, a lot of the components have been kind of sold off. Actually, I don't have the statistics right now, guys. So you guys can look this up. But when we ended the week last week, we only had, I believe, 2 or 3 of the Mag 7 that were still actually above their 50-day moving average. I mean, we actually did see a consolidation or pretty much almost a correction. That the XLK, if you're looking at the technology sector for the S&P 500, if you look at the technology sector for the S&P 500, the actual component, do not look at the XLK. It was actually in a technical correction, right? We hit like 10.1%, 10.2% high to low intraday. If you're looking at intraday lows, intraday highs. That's enough to maybe get some buyers to kind of step in, though, right? So I think this is you treat it like a flag pattern for now. You don't get too bearish at it at this point in time until you see, once again, another lower high and then a breakdown below that 62.5, and then you're looking at the 200-day moving average in red. So once again, I think if you look at the individual components, it tells you get a little bit more optimistic if you look at the individual components rather than the overall indexes themselves. And that just sounds very familiar, right, guys? I mean, and gals, at the end of the day, this has been a stock picker's market for the last month and a half, 2 months. This hasn't been an index, throw it in an index, and then everything's all good to go. It just hasn't been that way. And actually, I enjoy those type of environments, a lot more alpha there. So now, for now, you treat this as a bull flag pattern. Anything below that 62.5, you get a little bit more concerned. But if I pull up a chart, and I didn't bring a Microsoft chart, but if I bring up a Microsoft, it's definitely in its third wave. If you're an Elliott wave kind of believer that we have corrections, three parts to the downside, you have counter trend rallies that obviously also kind of move to the upside here. You could make the case that this was in its last leg or last wave to the downside. Very bullish candle on Friday. We did reject the 20-day moving average on Friday. We got to be kind of mindful of that, but a pretty strong bullish candle. So I think that, and the MACD is trying to hinge up here. I think this kind of sets up for, once again, that rotation trade back into mags, maybe selling out of some of these other sectors that don't have a theme, a strong theme to them. And I think that's kind of how we resolve this. And unfortunately, that actually, I don't say unfortunately, that probably does lead us a little bit higher. I just wouldn't be too confident about that higher move, just to be frank with you. But it could lead to things being a little bit higher here.
Yeah, I also think, just looking at the RSI too is, we haven't hit those oversold levels until very recently. It looks like we just kind of barely dipped into oversold here, continuing to look at lower highs. So momentum is continuing to move out. As we're obviously all seeing, money is moving into different sectors that we haven't seen for some time. So I think that, this could be continued to the downside. And that's going to be an interesting dynamic. Like a lot of people, we'll have people on, we'll have these conversations a lot, Kevin, which is what happens to the S&P 500 if we have the Mag 7 falling. And for me, I do think like the Mag 7 is such a large part of the S&P 500 currently that if the Mag 7 isn't holding up, we're in a scenario here where the S&P 500 is most likely not holding up as well. Whether energy, materials, let's say regional banks and so on, let's say these are moving up, I don't think we're in a scenario where that really holds the S&P 500 up anymore. But what do you think about that?
Yeah, I think the rotation trade, and I'm a huge believer of this. If you kind of think about this selling out of tech and having those dollars kind of flow into other areas of the market, that rotation trade is building a foundation for us for price. That's how I look at it. So at the end of the day, yeah, it's going to rotate eventually back into technology, back into communication services, back into consumer discretionary. Those are the three bigger weights that have influence as far as news headlines and market sentiment, if you will. But even when we are seeing some of those sectors kind of pulling back here, we are not seeing dollars moving out of the S&P 500 or out of the market. And that's where you get a little bit concerned. You get more concerned if we saw a sell-off in tech, and then we also saw a sell-off in utilities. We also saw a sell-off in healthcare aggressively, or consumer staples. That's just not the case. In fact, consumer staples are technically, if you look at the XLP, it's technically in a breakout of a bull flag pattern as well, right? It was a long consolidation, but we're breaking out. So as long as we kind of get, two or three sectors leading one day and one sector lagging, I think we kind of hold up at these areas until we start seeing net negative or outflows taking in the place in the S&P 500. That's when you get a little bit more concerned. So are you going to see a one-for-one, direct one-for-one relationship? Oh, I'm selling out of all of this tech, and then I'm going to dump it all into staples. Institutional traders don't trade that way. But it doesn't also make that much. It doesn't take as much dollar flow to impact a smaller sector like materials or like consumer staples, right? And so that's where you can see kind of that relative outperformance. So I think the market can survive without the Mag 7. You just won't have the outperformance like we've seen over the last 2 years, 3 years, which the outperformance that we've seen over the last 2 years, 3 years has been abnormal if you're looking at a 30-year, 20-year time frame as well. I mean, we always have to put that in perspective.
Yeah, I think it's people are looking, and it's funny. Mev Faber would always share things over, the past 20 years that I would see, and basically all about like, hey, what are investors' expectations for the next year? And the investors' expectations for the S&P 500 was always like north of 20%, or the retirement accounts north of 20%, because you had this crazy outperformance in technology all these years, and it was holding up the entire S&P 500. So people got used to these plus 10% returns. And I don't think there would be anything insane to say, like, say the Mag 7 starts to slow down, technology starts to slow down. This happens over time. I mean, even we're seeing the technology isn't dead. It's just money's not flowing into these big names currently. They're flowing into these small cap names. Let's say we're in that type of a scenario. We get to 5% returns. People would be, their minds would be blown. but that's very normal. That's about average actually for the S&P 500 over time. So I do think that that's the scenario that we're going to kind of see going forward. So sorry about that. So let's get to natural gas. I'm in Ohio. I wake up this morning. Basically, yesterday they were like, "It's the end of the world." I'm like, "Yeah, whatever." Didn't really see much. Went out to the grocery store. Everybody's buying stuff like crazy. Bananas, I guess, are the hottest thing in the world today. Don't understand how the hell that happened, but I guess bananas are the thing that everybody wants. Toilet paper, once again. I mean, I don't know what's with Americans toilet paper, but we get really upset when we don't have toilet paper, so people are buying toilet paper like crazy. Whatever it was, it seemed like people were panicking a bit. Wake up this morning, I'm covered in snow, like basically the whole yard is. Dog's having a rough time. Small dog hack for me as a Chihuahua guy: go take a tarp, put it outside before it snows, and then when it snows on the tarp. Move the tarp. You have fresh grass under there, and then put the dog on there to go to the bathroom. Just a little hack. But anyways, it's a good one. So anyways, I go out there, it's just crazy. And then, but Kevin, you've been talking about this all week. I know natural gas traders always talk about the coldest time of the year, the coldest days of the year. I think that might have been last Monday. This is when we saw natural gas start to make a big move. And then you had this big cold front coming in and so on, which continued this move higher. And you've also been sharing some really great stuff about natural gas and what you're thinking about it here. So I wanted to get your opinion. Like, what do you think about natural gas? You think this is viable? You think this is short-lived? We've actually done this. I was thinking about this, Kevin. We did this last year where we talked about natural gas and the trade that could happen and what happened with the big pop, because there was another big pop that kind of happened similar to this last year, not quite to this extent. But, what are you seeing here in natural gas? What are you thinking?
Yeah, look, all right. So those that do watch and have been watching us for a very long time, usually around September, October, we talk about the seasonality of not only natural gas, but also when you're looking at heating oil, because you can have these weather events that do take place. It's usually abnormal for us to not actually have a major weather event. Now, this one might be the big one. Who knows, right? We hyped it up. Everybody's hyped it up. And let me just say, yes, if it hypes up and then you don't get the result, I understand people are going to be like, oh man, see, they were wrong. But it's better to be a little bit more prepared. The hype is not for you boys in the north, you gals in the north. It's not for me here out in Denver. This is a regular Sunday or a regular weekend for us. But if you go down to Atlanta or you go down to Florida or even Texas, right, and they experience any type of cold weather or any type of ice, a lot of them don't really know how to deal with that. So I think that's probably why you have seen, obviously, this kind of enthusiasm and trying to be really aware of what could potentially happen. So this is a weather storm. Why is natural gas moving higher? You guys are gonna be like, well, KG, duh. Yeah, obviously it's gonna be heating demand, it's gonna be electricity demand. Exactly. But what's also actually very interesting about this natural gas situation is that it's like the right place at the right time. If you're looking at just market structure, and I think this is going to be very interesting and very important for people to understand, because I've seen all last week, natural gas moved up 87%. Like, utility prices are going to go through the roof. This is the time. And, I've also seen like major short squeeze, and you're having, institutions getting blown out and all of these different narratives that are taking place. This is nothing new, okay, with natural gas in a weather event like this. And here's the reason why I say that. Now, technically speaking, you're hitting the upper end of resistance here. We tested this upper end of resistance back in December. Once again, had a lot of enthusiasm. Everybody was saying natural gas is going to $10, $11, $12 or so. We saw a sharp pullback. Could we actually see the same type of reaction this time around? Yeah, we could actually see that same type of reaction. Now, natural gas over time, this is 3-year weekly, we are making higher lows, right? There are some structural things or some fundamental things that we could see that actually could increase demand, data center build out, things of that nature, right? Rightfully so. But at the end of the day, what's actually happening here, the contract that we are looking at is the February contract, okay? So natural gas, you could trade the whole natural gas curve. There's a bunch of contracts that are available. February was the front month, and it was the active contract going into last week. All right. So did you have maybe a short squeeze taking place? Probably, right? Natural gas is probably the biggest and the highest shorted commodity that is out there that's very liquid and tradable. right? Just because we have an abundance of natural gas. And I wrote about this. We have an abundance of natural gas as a result and byproduct of shale production. So we have that type of situation. We have more than enough in storage and inventory. We do have LNG exports, but until we start to see those export facilities kind of really ramp up, which we are expecting over the next 2 years or so, we could see LNG export capacity almost 2x at this point in time, actually almost 2.5x, almost 3x. That would actually then push prices to the upside when it comes to natural gas, because we have something to do with this very abundant fuel source. But what's happening is this is a front month contract, and this contract for February expires this week. Usually when you get to the last week of a deliverable contract, actually the week before, you start seeing individuals rolling out, going from that front month active to the next active contract. Okay. That's because there's delivery risk that's taking place. You want to make sure that there's enough liquidity. So a lot of institutions are not going to really trade front month and have a long position, right? Meaning a duration or a durable long position for a considerable amount of time, because the contract's going to end here. And that's also fueling this. I mean, you're looking at a contract that may only have around 34,000, 35,000 when it comes to open interest. That's what we were sitting at on Thursday. But the total trading volume for natural gas across all contracts hit like 1.4 million, 1.5 million contracts traded, which is crazy. So what does that really kind of represent? Now, a lot of intraday trading, a lot of scalping that's taking place, but not really any sustainable positioning that's taking place in this market. And this is showing that backwardation. What is the price of the February contract compared to the March contract? And right now we are seeing a considerable difference between the two here, about $1.60, $1.70. Let me put that into perspective. For one contract, that's $17,000 difference in pricing just for one contract of natural gas. This type of spread happens when we have near-term risk that's not being priced out across the curve. Now, as the March contract, did it move? It did, but it didn't move as aggressively. It's still actually trading in the threes. If you look at the net gas contracts last time that I checked, and I'm going to check this right now, it's trading at around $3.50, $3.60 or so. $3.64 is the Feb contract, or the March contract, my apologies. The Feb contract is trading at over $5. But what's also going to happen mechanically, you will actually see a convergence coming in over the next couple of trading sessions. That means either the Feb contract is going to move to the downside, or the March contract is going to move to the upside, so we can see those contracts kind of meet. They might not meet perfectly just because of the weather event, but we should see a convergence, because there is a playable spread that is out there that I'm sure several institutions are looking at and saying there could be a play here in order to do that. Now, this is not a recommendation, but how would an institution do that? They would go long that March, and then they would short the Feb, right? Because you're looking for that spread to come in or consolidate, or narrow, if you will, right? So did we see a massive rise to the upside for Natty? We did. If we actually rolled that March contract today, you would see about $1.50 drop in prices on your chart. That's just how the structure is actually taking place. We are seeing some disruptions also in the market as well. But I get a little bit concerned about this. This is one of those things that you buy the news report, you sell the actual event. You buy the weather report, we sell the actual event. Now, the interesting thing that could happen here is, what if we actually get something that comes on the back of this once again, right? Big snow event that also then takes place 2 weeks from now. Then that could keep natural gas prices elevated for a while. But once again, if you're kind of looking at the fundamentals, I think this one has kind of traded out of lockstep with what the fundamentals are. We know that there's near-term risk, but when those risks abate, once we see that first weather report that says, hey, we're going to start seeing warmer temperatures coming up, I would not be surprised if you actually do see natural gas aggressively re-rate to the downside.
No, I agree. And one thing you kind of made me think about here, Kevin, which made me kind of laugh for a second, which is, do you remember this guy?
Yeah. Yeah. Well,
optionsellers.com, man. Optionsellers.com. So basically, long story short for you guys who don't really know, 2018, there was a guy who was basically their strategy was basically selling put options, naked puts on oil, and then selling call options, naked calls on natural gas. You had a weather event in 2018. You get a huge reversal. The shorts basically start to cover those positions into natural gas. Natural gas just moves through all their strikes, wipes it out of 150 million pretty quickly. He makes a video about him, basically apologizing to all of his investors for blowing up their money. But this is how these events kind of happen. This is why I don't think selling naked options in commodities markets is a very good idea. Silver for a good recent example of this. So, but no, I think that natural gas, it might have legs, but at the same time, I think you're right, Kevin. It's something that you've brought up many times, is that when we see this type of disparity between the front month contract, we usually see this move not really have anything to really sustain it much further than, hey, there's a weather event. If you were in the front month contract, great. But at the same time, it could come right back, start to go back to the downside pretty quickly, or it could just go sideways here. I would be surprised to see this thing really take off, because every time Kevin has brought this up, it is the same type of scenario where we don't really see natural gas in a very sustainable move higher. So what do you think, Kevin, just fundamentally speaking, technically speaking, do you think natural gas could continue to move, or do you think it's just a scenario where we're probably going to see this thing kind of give up the ghost pretty quickly?
Yeah, so I have never seen a spread differential like this that's been able to sustain. So here's the reason: the internals matter, guys. The internals matter. If we had an 80% move and that spread was only sitting at, let's say, 8 cents, 10 cents, 15 cents or so, or whatever, 60 cents for that matter, then it would be like, wow, this is actually very bullish. Because what does that mean, right? That means that all contracts are kind of moving in lockstep. Now, you go look at the March contract, it did move. It moved to the upside, don't get me wrong. But the spread differential itself is so disjointed at this point, especially going back to those facts. This is going to expire this week. One, open interest is only like 30,000. When we talk about open interest, that means that those are the amount of open contracts. If I sell a contract right now, if I'm selling for whatever reason, right? I sell one contract, I add one to the open interest. I buy that contract back, we basically take away from that open interest. There's only 32,000 contracts, 34,000 contracts that are active here, but you're seeing 100,000 in trading volume. At some point in time, that volume is going to drop off, and you're going to have spreads that widen out, and you're going to have a problem. This is exactly what happened with oil going negative. If you think about it, somebody got in, they started doing a lot of trades on the front month, boom, liquidity got pulled out, and then they were the only open interest. And guess who they're trading against? A market maker that's going to tell you, okay, yeah, you want to get out of this? Guess what? Because this is a deliverable contract technically. So I would be very careful when it comes to trading natural gas, just in general. But like in situations like this, that front month is moving 10 cents, 15 cents in a matter of seconds. It's wild. So the spread being this wide, I just don't think that it's sustainable at this point. And if it is, and we do see this kind of disjointedness going into that March contract, and I think it does provide maybe a little bit of an opportunity that we have a massive re-rating. But I think hitting that upper end of resistance, knowing that this is a one-off event, that we will kind of see backfill. Infrastructure has not really been impacted outside of maybe some things happening in Texas. We haven't seen anything that's been meaningful here. And I think the only way that you're going to be able to sustain prices for natural gas is having a disruption in supply. Now, I mean, even from the demand front, I mean, unless this turns into the worst winter on record and we stay at these levels, this cold weather type of event for the next month and a half, 2 months, which is not being forecasted, I think natural gas might see a pretty aggressive re-rating back to the downside once we kind of get over this. And I'm not sure if that's going to be a Monday or Tuesday, but the closer and closer you get to this expiration, I think you're going to see some people try to capitalize on the spread differential here.
I think that's correct. When you look at expirations for natural gas, also, you see a pretty consistent sell-off and moving in the next contract, or even a sell-off through the contracts all across the board. So, you will probably see a pretty steep sell-off probably getting towards that February expiration. So continue to keep that on your radar, guys, but I think that's a great explanation of what we could be seeing here. So here's the next chart, Kevin. So what are we seeing here? So system-wide prices, electric reliability, Council of Texas. Yeah. So what are we seeing here?
We won't even spend that much time. So ERCOT, basically, they're the independent, service provider, if you will, for Texas. And what I found very interesting with this chart, obviously, Texas is it's a concern. They pretty much 95% of their production is in house. Don't have access to the international grid. There's a small slice of Texas that does, but nothing that's going to be impactful, right? They have an independent grid system, and so concerns around freezing rain or ice kind of impacting electricity. We are seeing some impacts. There are some outages that are taking place. But what's interesting, this is actually in real time. I just got this right before we started the show, right? So the prices, this is over the next 24 hours for the most part, right? Or this is today, but over a 24-hour period. Prices are expected to go from $1.28 on average up to around $1,480. So like they're basically expecting tonight is the night where you're going to see the biggest draw for electricity demand here, which is wild. That's a 1,000% increase on an intraday basis on electricity prices, and rightfully so, right? Like they have a closed system. There's going to be a lot of demand. You are already seeing that in certain pockets of this market, but the variability in prices. I just thought this was actually a very interesting chart, just to kind of throw it out there and say, hey, like this is a big deal for some, and especially for those that are in the South. Us up here, we're not really worried. I'm out in Denver, basically, not a real big issue here, but very interesting to see. I just thought that would be a nice chart for the whole winter weather disruption situation that's taking place here.
No, that's pretty wild. It's quite interesting. Something to
Yeah.
keep in mind for everybody, especially like people in the South. I mean, they don't like people in the South. When you go, my grandmother was in North Carolina growing up, so I'd go down there. Basically, if there was any bit of snow, you'd see the whole city shut down. Like there was nothing.
Mhm.
They just didn't even understand how to drive in it. Had no idea what to do with it. So everybody would just stay home. Barely like basically a light snow for Clevelanders or people in Michigan or Chicago. In North Carolina, it shuts down the whole city and nobody's going to work that day. So it's pretty interesting.
Yeah.
So here we got heating oil. So everybody's
Yeah.
looking at heating oil. People are getting some information, looking at natural gas and going, well, heating oil's got to move too. But what are you seeing here, Kevin? We're looking at this MACD starting to cross over. We're seeing a little bit of momentum show back up in the RSI. This thing has been dead sideways for a long period of time. Now we kind of have this inverse head and shoulders pattern that you're pointing out to here. And then getting above these levels, maybe that is that the 200. Yeah, that's the 200 day. That could be a significant move if that happens. So what are you seeing here, Kevin?
Yeah, so that's the 200-week moving average. I'm a fan of weeklies.
Me
I
too.
like the weekly charts. So that inverse head and shoulders pattern that I'm calling out here, I like to leave certain things on my chart. I don't like, if something doesn't play out, I don't really like to remove the chart pattern that I was looking at before, because it gives you a little bit of perspective of what actually did happen, and do we see actually a breakout. We had this inverse head and shoulders pattern, but we were unable to break through that neckline. That neckline is still going to be in place at this point. You are seeing a significant amount of demand within the Northeast region, which is exactly where heating oil demand or diesel demand, for boilers and things of that nature, is ramping up very aggressively. And in fact, a significant portion of the power and generation that's being used within the New England area is actually coming from fuel oil and other oils, which is a little bit unique. But that's going to draw on the supplies, if you're kind of looking at diesel supplies that are already kind of depressed at this point. So this has a little bit more seasonality. They are seeing obviously a stretch in demand here. You have that MACD on the weekly starting to cross, but you got to break that neckline. And I'm not sure if it's going to be able to do it this time around, but you are starting to see a lot of the energy products starting to kind of base out here. That neckline is sitting at around $2.66. So this is a contract that, once again, doesn't get a lot of love. Heating oil, diesel is literally 99% of it, 95% of it is exactly the same thing. We just throw dye in one and we don't throw dye in the other one, and we tax diesel and we don't tax heating oil, right? So weird kind of system here. But keep your eye out on this. So this one's trying to base out. There's a demand story that is there, definitely in the Northeast. It has drawn on supplies. You are seeing in real time, oil power generation, which is something that's kind of unique in the United States. Like, we've got to divert to that. That's stuff like China does. Let me not go on a rant, but like, there's a demand story here. I would not be surprised if you kind of see this re-rate. Now, the only thing that you have a little bit of an issue with, and we'll see how this gets priced out this Sunday, we are actually seeing the CPC port within the Black Sea, they're starting to actually put production back online. That has been actually a big driver for a lot of the energy move to the upside for oil, gasoline, and diesel. This is because Russia-Ukraine conflict. It's been delayed. Kazakhstan has not been able to put production online the way that they would like to. Today, it sounds like they actually do have one of those I call it Moors, but basically one of those production lines back up and running. So that could actually dampen the supply story here. But heating oil has a little bit more of a seasonal effect to the upside that could actually push those prices higher. Let's see if it breaks the neckline. That wouldn't be great for inflation at all, but for the oil bulls out there, for the energy bulls that are out there, heating oil is very volatile, probably a higher beta product than any of oil or gasoline. And I think it gives you kind of that first signal of what's going to happen next for a lot of these other products.
No, I think this is something that I think a lot of people aren't going to pay attention to, is what's going on in heating oil, what's going on in gasoline. The distillates also really matter, and also understanding, the underlying commodity has been under a lot of pressure, but we've started to see that bottom out. And something, we can talk about here, Kevin, and I think you brought a chart of oil, if I'm correct. Yes, that's the next one. Yeah. So basically we saw this week was the Maduro situation. So basically, we were in different areas. We had a kind of a big event happen, and basically oil kind of bottomed out right there. So just asking you, Kevin, what are you seeing in oil? Do you think, oil has more upside? Do you think it's going to just continue to the downside? Or do you think this is a situation that is sustainable? Do you think this is a sustainable move in oil and we could continue to see more upside here?
Yeah, I think over the next couple of weeks, and I'm not trying to hedge myself. I just want to give all of the I want to give you all of the factors that could go into this oil trade. All right. So leading up Thursday, Friday, there was a bid put in oil because of the weather risk events, the potential to see flows disrupted going down to the Gulf, right? Rigs being taken offline, forced to be taken offline within Texas, the Permian, Eagle Ford, you name it, because of this issue. Maybe this also kind of spreads to North Dakota. You have potentially the Bakken region having an issue when it comes to oil and natural gas flows. They take rigs offline as well, or they shut down production or pipelines. That kind of fueled that move higher, right? Then Friday, lost in the background, there's also this geopolitical risk event with a potential strike in Iran that was also playing into this. You've seen this every single Friday, right? People go back, and we're not going to get into the politics. It's just trading. I got to throw that out there because I don't want to get in trouble for this. Generally, we have seen more about military actions being taken place over the weekend, right? When the markets are not open, the traders, investors can kind of digest what's actually happening, and then it reprices on Sunday. So there's been this trade where Fridays have actually been bid days for oil, for gasoline, for heating oil. That's just been kind of the trade over the last 3 weeks. And as we get closer and closer, you start getting these updates about, certain military equipment getting into place here. Obviously, that risk kind of ramps up a little bit more. So I think the geopolitical risk is also kind of pushing this up. The weather events are kind of pushing this up. Technically speaking, the 50-week moving average is going to be your area of resistance. We have broken through it before. You can see that, but we have not been able to sustain above it. Now, you can make the case, hey, Kev, we've been actually seeing some buyers stepping in at $55.50, $56. That is true. That has been able to hold, right? So we've tested it maybe 3 times already on a definitive basis on the weekly. So is it trying to curl and move higher? It is. Is MACD trying to cross in a bullish formation? It is. Is RSI breaking that lower low or lower high situation? It is at this point. So the technicals kind of give you a little bit more of a bullish take. I would still say the fundamentals right now still seem to be supply driven. It's still short-lived events that are taking place. There's nothing that's seeing a structural re-rating to the upside when it comes to consumption of gasoline here domestically. China has days where they have really good economic data, and you're like, man, the industrial boom's ready to come back. And then you have other data sets from China that saying, oh man, they're still like in a rut right now. So I would say, technically speaking, the 50-day is your resistance. Do you get a little bit above that if you have a geopolitical risk event? I think so, but I don't think the fundamental side has really grabbed hold yet. But you do like to see that technical structure, that 55, really kind of holding here. I mean, we're trying to curl. And what you'd like to see is a breakout above that $66.60 level to kind of give you maybe a little bit more confidence that this time might be different. But there's a lot of headwinds that are there as well, right? We will see an increase in Venezuelan oil coming to the United States. There's already been deals that have been done for that fashion. It's a little bit heavier sour, so we should also then have some of those heavier byproducts kind of increasing when it comes to inventory levels. That's kind of bearish for the overall market. We have these swaps that are going to be taking place between Venezuelan oil and U.S. Oil. That's also going to be, for the most part, in my opinion, a little bit more bearish for the market. So I'm a little bit more 50-50. If you took the name off of this, let's say like this, you took the name off of this chart, Jason, I would say, yeah, this actually looks like a decent little try to scalp it to the upside here over the next couple of weeks. If you just took it off, if you look at some of the fundamentals though, all supply driven, all geopolitical risk driven, nothing on the demand front that really gets me very excited about oil at this point.
Yeah, I mean, for me, when I look at it, I always think of the scenario that we could get into here is kind of when we look at oil and we look at demand and we look at these things, like once again, if you look at the chart alone, you could make a case for it. But also the chart and the price action, as we both know, tends to front run the fundamentals over time. Now, once again, that doesn't mean I can be right, that I know this is going to happen. And just saying most of the time, I'm just going to follow the chart and kind of think through what's actually happening after that. That doesn't mean that Kevin and I will get on from time to time. We'll have these kind of discussions, and it's, sometimes Kevin's right, sometimes I'm right. And we'll see what happens here. But I think it's something that I want to keep on everybody's radar, that oil and energy look very interesting. And I think there's a lot of reasons for that. Oil has looked like crap for a long time, though. So I really want to see oil really stick this move. I want to see oil really get back up to, let's say, 70. Oil starts getting to 70. I think then we have a real trend starting, and a sustainable one. I really love to see it get over that. Is this a weekly? Yes, I'd love to see it get over that 200-week moving average. That would tell me so much that we haven't seen in so long. Really sustaining up there. I think it's all systems go at this point. But I like, the energy sector. Somebody asked about that in the chat. The energy sector looks great. That was on Twitter. But the energy sector looks great. I think it, buying some things there probably makes a lot of sense. But oil itself, I'd probably stick to the energy stocks currently, then get into oil slowly as this thing starts to move. Heating oil looks like it's even closer to a really strong buy signal. So, pay attention to these things. I think we got a lot coming up here for the markets.
Yeah. I just want to kind of call out a couple of things here, because there's a question. If we can go back to that chart. So we have a question around, are there risks in the energy trade with Canada, with Trump and Carney using more aggressive action and rhetoric? So we won't get into the politics. Background, Canada kind of, exports, let's say 3.6 to around 4.1 million barrels per day on average to the United States, heavy sour crude, right? Which is something that we're also about to, over the next couple of years, get from Venezuela. Right now, Canada trades at or sells that to us at a little bit of a discount. I don't even say it's a little bit of a discount. It's a discount. And it's a major part of our refining mix here in the United States. So a very critical area. Could you see maybe some tensions kind of brewing up and that being leveraged? I think if it gets to the extreme, that's when you can see maybe Canada kind of pulling that lever right now. And what we've seen in the past, even with the trade war between Canada and the United States, the oil trade or the energy trade as a whole, even the ag trade for the most part, has been exempt on both sides from any type of action. Could that be something? It could. For right now, it doesn't look like that's going to be the case. And if there was going to be some pullback and flows to the United States, that would be, I would say, catastrophic when it comes to refiners here, as well as the price of gasoline and other byproducts moving to the upside. What's also very interesting with Canada, keep your eye out on this. So we had the Venezuela situation. Obviously, everybody's like, hey, Venezuela is a huge exporter to China. China actually stopped buying Venezuelan oil like a month and a half before that situation with Maduro. Who did they start buying oil from? Canada. They actually replaced the Venezuelan supplies well ahead of this particular situation. And there's a lot that's in the news there. Why do I bring that up? is because those Canadian energy companies might be seeing actually a fundamental and a structural shift within their own industries, where demand starts to ramp up pretty aggressively before it's heavy oil, not only going into the United States, but also export demand might be ramping up pretty aggressively here as well if China, if this trend with China continues. So keep your eye on those Canadian energy stocks.
No, I agree. I think that's a great way of answering that question. And so, speaking of, we'll get to the next question from Free Lee after this. So, agribusiness ETF move. So, this is something for me also I've been paying a lot of attention to. We did buy this breakout in the fund and for our subscribers as well. So, we did buy this recently, got that nice breakout, seeing where it ends up. This thing's been dead sideways for a really long period of time. And this also usually leads to big moves in the commodities markets as well. These bottoms tend to coincide with copper bottoms, not to mention same with energy. If we're looking at XLE or if we're looking at oil, like these also kind of go hand in hand. So what are you seeing here, Kevin? We also have a comment from Free Lee here. So does this type of weather usually affect live cattle, feeder cattle, agriculture, and so on? Great question. Kevin's the person to probably answer that very well.
Yeah, so I'll answer the question first, and then we can kind of talk about this ETF and what's happening with these agricultural stocks. So the question is yes, or the answer is yes. Does the weather actually have an impact on live cattle? Any type of livestock is going to have an impact right now. It depends on how long that this actually does kind of take place. This could actually impact weight if it's a very prolonged type of situation. But once again, the weather reports right now say that this is going to be short-lived, but this does put stress. And it's not so much the live cattle, right? The live cattle, if you're looking at live cattle and the prices, those are what's being pretty much brought to market for slaughter, right? Like, if you're at the end of your rope, next 2 weeks, is it going to have a major impact on you? No, not so much. Feeder is the problem, because the feeder cattle are the ones that you're still trying to raise to full, I would call it to full market weight, if you will. I want to say it in a way where it doesn't sound like absolutely ridiculous, but the feeder cattle market has been moving to the upside here, even though we have seen a lot of headwinds that we would see beef imports coming from Argentina and some other places, even potentially Mexico, things of that nature, that could actually increase beef supplies, which did put some pressure on the live cattle market as well as the feeder cattle market. But yes, there's going to be a lot of stress across the board, from chickens, even turkey. Turkey demand is falling off a cliff. You name it, it will have near-term stress. The big question is, how long does this last? And will it remain? And will it actually have a meaningful impact on the overall economy? I think that's a question that can't be answered. The agricultural stocks themselves, though, have been consolidating, and now you are starting to see some buyers really stepping in. So we are testing the 200-week moving average. We're looking at move, and I'm just using this as a proxy. If you actually look at some of the individual movers, though, Dow is still kind of basing out, kind of broke out of this first kind of formation, hitting the 20-day or 200-day moving average, breaking above that. You also have ADM, which is a processor of soybeans and a lot of our agricultural grain products as well. That one actually has been moving very aggressively, actually over the last 6 months, 7 months or so. And that's one of those, let me go sidebar here. That's one of those stocks where it was continually it was getting beaten up pretty aggressively, right? ADM, they had some internal financial issues when it comes to reporting that concerned the market, but it was paying a pretty healthy dividend, and they never cut it. And so now, at those lows, it was actually a pretty penny. I mean, I think it was 8.5% or something like that. I mean, there was definitely a risk that could have been cut, but now it's actually kind of reversing to the upside here. So a lot of these stocks have been kind of broken down, basing out, trying to break out to the upside. And the notion is in 2026, biodiesel demand is going to move to the upside as well. So if that's going to be the case, then crush operations, which ADM has exposure to, those crush margins can also then improve, since domestic demand is going to go up. There is obviously a global glut when it comes to soybeans in some respects here. But when you're looking at crush margins and soybean meal and soybean oil, there's a lot of optimism this year regarding that. And ADM could be a very big contributor of that. There's also this risk of any type of fertilizer disruptions. We talked about Canada. That's where we get a lot of our the inputs for our fertilizer is from Canada as well. So I think that's why you are seeing Dow kind of move to the upside. But even these seed stocks, the last thing that's actually also another tailwind is we have seen a government stimulus, or let's call it a stimulus package, bailout rescue package for a lot of the farmers. So that has been announced. And a lot of those farmers, if you're kind of looking at the aggregate, not just like the institute, not those large companies that own these farms, but actual like farmers that literally rely on these crops. A lot of them finance their operations to start the year, sell their crops, and then they take what they make and then pay down that financing that they did for that prior year. Then they refinance that into whatever they're doing this year, right? The margins when it comes to growing crops here in the United States, from soybean, sorghum to wheat to whatever, you name it, hasn't been that great for a very long time. Now, what's also very interesting is that it sounds like there's going to be an additional package that's being put into place as well. And so the market is also kind of bidding up a lot of these stocks because they do believe that those rescue packages are going to flow right back into a lot of these companies to ramp up operations, to pay down their existing financing that they had for the prior year. And that's another reason why you're seeing a lot of these tailwinds here. But I don't think that, I'm not sure about the correlation between like, oh, ADM's going up, so soybeans are going to go up. I'm not like I don't have that. I don't have that relationship. I've never done that back test. So I'll be completely frank with you. I think on the soybean front, there's still a lot of headwinds, but a lot of these companies on the ag front that are publicly traded have been beaten down. And you can make the case that maybe the valuations have look attractive compared to the broader market, and maybe some of the tailwinds that they're going to see this year are going to be directly a benefit for them. So a stealth mover that no one ever talks about is starting to move aggressively higher.
No, I like this one. It's just it's a great sector, and there's a lot of things that are going to make a lot of money, and especially if we're in a scenario where we start to move out of technology and into these other products that just haven't been getting much love lately. And like you said, like the market's kind of looking for these undervalued areas, as well as this one moving within the commodity cycle. You know, if we're looking at gold, we're looking at copper, all the metals, miners, nickel, aluminum, you name it, basically everything is moving that's a metal at the moment. We'll most likely see that kind of run into the agriculture space as well, especially the agribusiness at first. And like Kevin said, you know, I have done a little bit of work on that. I do see that most of the time these two sectors run together, but once again, take each trade for its own. You know, like I would love to say I'm just going to buy moo and I'll buy soybeans at the same time, but you just never know. So continue to just take the signals as they come. Soybean gives you a buy signal, take it. Corn gives you a buy signal, take it. And I assume that at some point these things will all run together. But for now, these trades are just taking off. It could take some time in between. Think about energy. Energy is, look at ExxonMobil. ExxonMobil breaks out. I think that was, a week or so ago. And then you have, oil kind of sitting at the lower bounds. You don't just go in and say, I'm going to buy oil because Exxon's moving. You buy ExxonMobil. And then you continue to buy these different names inside of there. And that's how you take the trade. You take the strongest stuff first. So you'd buy moo, for example, first, and then you'd go back through and pick out, okay, I want soybeans. Okay, maybe another agribusiness stock that's not in this ETF and so on. Maybe you pick some individual names, take them one at a time. That's how you trade well. So continue to just do that going forward. And so, Kevin, two more charts and then we'll get out of here. But real quick, if we're looking at silver, we're looking at gold. What the hell is going on with silver, Kevin? That's all. That's the only question I got for you.
I don't know, man.
You're going to give me the exact answer. I need it from Kevin right now.
All right. You want to know what's going to happen? I don't know. Look, I mean, obviously we hit that milestone of $100. I think it closed at like 103. There's a squeeze happening. Some of it's obviously fundamental. I think that there is a fundamental story to be had there on the silver front. I think a lot of this is just also kind of just a squeeze and meme-ish type of activity. I mean, dude, I think almost every single day last week, except for one day, I've woken up to SLV. No, I'm saying SLV, not even silver, but SLV moving 3.5%, 4%. Like it's wild. Can it continue? It could, right? I mean, like you are seeing, I think this is kind of, and I've been saying this for a long time, but tell me this doesn't look like blow off top type of activity to me. It does, but until you actually have the fundamental case, or somebody comes out and says, "Hey, we're going to stop buying for a while." China comes out and says, "You know, we're going to hold off," or the U.S. or what have you. When it comes to these precious metals, right now it seems like it is trying to squeeze. Now on the silver move, what is kind of good is usually silver is more of a indication of economic growth in a sense, and that should actually be conducive for equity markets continuing to move higher, right? And so you got to own those. Yeah, you got to own those hard assets. Yeah, whoever said that, you got to. The hard asset trade is the trade that's taking place right now.
Mhm.
There's a lot of uncertainty, geopolitical risk taking place. Gold obviously moving a little bit higher as well. So this one can continue on. I'm done looking at the technicals. That happens every once in a while, where it's just like, dude, I don't know, right? You
Sure.
like the fund flows don't make sense. The inventory levels don't make sense, and we continue to see it run. And I'll be honest with you. I mean, at this point, I'm kind of an observer of seeing like how this actually resolves. I mean, there's a catch-up trade for silver for sure, but this one is getting really, 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 really stretched here. But don't get in front of the freight train. It'd be very disastrous for any portfolio too.
Yeah, I mean, I'm not a target guy by any means. I fucking hate the idea of it. I think it's pretty terrible to put targets in as a trader. Depending on what you're doing, you're a range trader, great, makes a lot of sense. You're a trend guy, let those trends run, because this is a scenario where like I never know. Like that's the answer for me is like I never know where these things end up. People think because you're a trader or something, you have some idea. It's really like, no, I trade it. I'm gonna buy, when it hits a new high here, or I see a nice breakout. That was, back a couple years ago now, and then you get a nice breakout. Then you kind of let this thing trend. It was very choppy, kind of a terrible trade, and then it started to kind of move. Came back, I think, around Liberation Day, and gave you one last chance to really buy a dip, and then it kind of just continued to the upside. For me, I'm gonna wait till this thing breaks down, starts to change trend. Then it's going to get out of it, or my trailing stop's going to get hit. If I was trying to trade targets in this, I would have been one of those guys who's like, oh my gosh, it hit $50, I'm out. That's resistance for the last 50 years. Or if I was, just doing it on feelings, I would have just got out a million times. You get a trade from 20 to 30, you want to get out. You get a trade from 30 to 40, you want to get out. But really, this is the type of trade that really makes your year, or multiple years, where you're just kind of sitting and riding a big trend and letting it run. If this thing hits 100 and then comes back to 85 and stops me out, or 80 would be the stop out point, I'd be fine with that. We've been in the trade for a very long time. If it keeps going, it goes to 150 and comes back to 130 and stops me out, I'll be happy with that as well. We'll see how it goes. But the target that has been put up by a couple of people I like has been 111. Sam Gatlin's talked about that too. So 111 was one that people think it's going to hit. I see most of the time when things get over a big even number that it hasn't been at ever, most of the time it runs a little bit further. So I wouldn't be surprised to see it hit 110, 120, something like that. But either way, like, just understand risk management here. Don't have a huge position. Use a stop loss of some sort. If you're looking to buy this, I just wouldn't. There's some people who keep asking me like, should I buy more silver? I'm like, I just wouldn't do that. That's pretty wild. But there are people out there right now. What's interesting, Kevin, is people are going and buying their silver at the store and so on, posting about how they bought $100 silver, which is just absolutely wild to me. But whatever, especially if you're physical, like, guys like Kevin and I will go like wait for these opportunities to kind of show up and then buy some silver, buy some gold. Certainly not going to buy it in a massive uptrend. That's for damn sure.
Yeah, I want to tell you guys a little bit of a story. So, like, I would always recommend, like, if you are just kind of, I mean, you have resources, everybody probably mostly in their town or where they live. You guys always have resources to get insights as to what's happening within the commodity market. So I would just like go to one of these shops that actually buys gold, not like a straight up metals place, not like a straight like a pawn shop. Like sometimes they just whatever, but like an actual place. So full disclosure, this is physical, right? I actually sold just 1 ounce because I wanted to just to do it, right? Because I've been holding physical for a very long time. And it was just like, dude, I would just love to go in there, walk in there, see exactly what the prices are, and I'll sell a bar out. And the owner of the shop told me actually something very interesting. One, he was like, dude, who would have thought that I would be like buying? So usually the spreads that these individuals or this shop would kind of transact in was around $2.50 to around $3.50 net spot, right? So if you're buying, you're going to pay over $2.50, $3. If you're selling, you're going to get less than $2.50 or $3.50 from whatever spot. Right now, he has his spread differential sitting at around $7.50 to up to $8 or up to $9, kind of depending on the day when they see a lot of volatility in the market. So that's one thing. And then two, you know what he told me? There is no premium in collectibles for silver right now. And that's crazy. What does he mean by that? If I went and melted a whole bunch of silver, and there's guys that do this, a streets rep or something like that on YouTube. This guy, he actually basically buys and gets a whole bunch of this like sterling silver and all this stuff, and he actually processes silver like in his garage, right? He's a chemist, like so he knows exactly what he's doing. But it's kind of wild because he's been doing this for a very long time. I know that guy's making absolute bank right now, but he said the prices are moving so aggressively that I can't pay any type of premium for collectibles of silver. Everything goes at the same. I could care less with the print. I could care less what any of it looks like. You can give me just some bar, and as long as it's 100% or 99.9% silver, I'm going to pay you. I'm going to pay you out. So he said, I'm done actually buying collectibles because I have a couple of these older, like very old silver coins, right? That I know go for a decent premium. And he's like, dude, I'm going to be honest with you. I couldn't even give you a premium rate on these right now because there's just so much stuff that's going on, which I found to be very interesting. So when you got the physical traders also saying, man, I don't know really what's happening right now, and the market's kind of shifted and we're kind of taking this on a day-by-day basis, that's when you know that you are in a very big and bullish physical trend that's happening. But just be careful with it. You can't hate the people that went long, though. You can't hate the people that went long 80. I mean, and silver's given us a couple of fake out signals as well on the daily, where it's like, okay, this is the reversal, and then like next day it's up 6%. You're like, all right, never mind. So
yep,
it can burn you.
That's interesting. That's something I have never heard before. Even in 2011, that wasn't something I ever heard before. This is something that we keep having to watch. And so, like somebody commented earlier, if we're looking at fiat currency or the US dollar and so on, we are seeing these things continue to break down. We're seeing commodities having really good days. We're also seeing the dollar break down right with that. So, once again, what are we looking at here, Kevin? Do we think the dollar is just going to continue to the downside? For me, I'm looking at all these different assets. If I'm looking at international stocks, if I'm looking at these commodities, metals, and so on, it certainly seems like the dollar's probably headed lower. The price action is kind of telling us the dollar's heading lower. The yield curve is kind of telling us like the dollar's heading lower. But once again, we all know it's a race to the bottom. If the euro starts outpacing us to the downside, that's going to give a boost to the dollar as well. So wondering, Kevin, what you think about the dollar situation? How does this kind of play into the commodity cycle at the moment?
Yeah, so the dollar had what we call, a bear flag type of moment. So a counter trend rally to the upside, but overall bearish trend that we've seen over the last year or so. The price action last week was not that great. Actually, we closed pretty much at the lows. We saw the Dixie move over 2%, actually even more than that, probably in a 1 week time frame. Basically, rejected the 50-week moving average. Yeah, 2.12%. So a very volatile week. Looks like we're about to cross in a bearish formation when you're looking at the weekly MACD right now. And if you kind of pull back, where do you look at an area of support is around that 90 level. Now, this also does kind of make sense. We know that the Fed is in a cut cycle right now. Usually when we are in a cut regime, we actually see the dollar for the most part be a little bit weaker because there's concern about the overall economic environment here in the United States. And I know some people are going to say, well, KG, dude, like we're about to print 5%, 5.1, 5.2% fourth quarter GDP. Look at the GDP numbers and see exactly where that's coming from. That's all gold exports and silver exports. You have a little bit of private investment that is kind of ramping up there. I mean, that's the data center trend that we are seeing, but I think that's sitting at around 1.1% quarter over quarter growth. So if you strip out the gold side of it, we're maybe inching positive for GDP growth in Q4. So be cautious of the headline number, and I'm not hating on that. Because what happened this time last year, Jason, we actually had negative GDP. Why was that the case? Because we were importing a lot of this gold and silver and all of these metals, right? The copper and all of that. And when we had that import, that's a negative when it comes to GDP. Also, GDP, just in general, we are importing less because of the tariffs. I mean, there's definitely a correlation that's coming in there with that. Importing less also is actually a net positive for GDP numbers. So I think the dollar is kind of saying, yeah, we probably will see a little bit of weakness, maybe because of some of the geopolitical risks and some of the things that have happened. Maybe you start seeing a little bit of a diversification away from the dollar. As long as it's a slow and steady or a grind to the downside, I'm not really too concerned about that. If we had a massive re-rating lower, right, and let's say like for whatever reason, 2 months from now we're trading at 90, I would be concerned because that just would be a massive unwind, and that actually would be conducive for a lot of physical commodities for them to actually move higher because of if you're kind of looking at it, it becomes cheaper on an export basis, right? So you get a little bit more activity there. So dollar looks like it wants to break a little bit lower. That has been the trend. That was the trend last year as well. So I'm not really too surprised by it. I'm not too concerned about it. I mean, the candle doesn't look great, but if it's moving down because of Fed rate cuts and for the right reasons, I think that's great. If it's moving down because of something else that's bigger than that, a transformational shift when it comes to the dollar reserve as the U.S. The world reserve currency type of situation, I get a little bit more concerned. I don't think that's the immediate case right now. It might be happening, but I don't think that's the immediate case right now.
No, I agree. So, all right, guys, thanks for joining us on Sunday morning. Hope we kind of broke up your viewing of the snowfall currently, because that's basically all there is to do today. So thank you, Kevin, for coming on. As always, awesome hanging out with you, man. Hopefully we come on soon, get a chance to talk about this more, see how these things develop, because there's a lot of things happening. The energy trade looks like it's taking off. The dollar looks like it's breaking down. And if we're looking at all these different commodities, they tend to be moving up right now. So I think that was a great show. And if you guys liked it, please let us know. Give us a thumbs up on YouTube. Definitely give us a follow there. We'll be live with you guys multiple times a week, and you'll get to see some weekend pop-up lives with Kevin and I. All right, guys, take it easy.